Hello and welcome. This is the Psaros Center for Financial Markets and Policies virtual webinar series that we're focusing on the SEC's recent ruling on private advisors. This is, I want to just welcome you all to today's webinar. The Psaros Center, just real quickly, is an academic-based, nonpartisan center housed in Georgetown's McDonough School of Business. And we, here at the Psaros Center, we produce high-quality, solutions-oriented research to promote and facilitate constructive dialogue on the future of global finance. This is the premier destination for unbiased expertise right at the intersection of financial markets and policy. And as part of that, we're committed to facilitating consequential conversations that lead to smart solutions to complex problems. We see this webinar as one of those examples today. Before we begin, I'm going to turn this over to Professor Sandeep Dahiya. But before that, I just want to make a little bit of plug for our Financial Markets Quality Conference. We call it FMQ Conference, coming up on Wednesday, November 15th, where we convene top policymakers and private sector leaders to discuss some of the defining financial policies of our time. It'll be an exciting forum for constructive dialogue on the most salient issues of the day, including crypto, digital assets, AI and the financial services industry, as well as market structure and more. So with that, I want to turn it over to, actually, before I do that, before I turn it over, I do want to welcome and thank our panel today. I want to introduce Tyler Gellasch, who is President and CEO of Healthy Markets Association, which is an investor-focused, not-for-profit, focused on increasing transparency and reducing conflicts of interest in the capital markets. Prior to launching Healthy Markets, Tyler served as counsel in the United States Senate, as well as serving in the SEC as counsel to SEC Commissioner Kara Stein. We're also pleased to have Brandon Rees, who's the Deputy Director of the AFL-CIO's Office of Investment. The AFL-CIO's Office of Investment promotes interests of workers' funds in the capital markets by leading corporate governance, shareholders' initiatives, and advocating for legislative and regulatory reform. Finally, we're also joined by Jason Mulvihill. He's the founder and president of Capital Asset Strategies, which is a firm that provides strategic advice, guidance, and risk management on complex legal, regulatory, legislative, and transactional issues that confront financial services businesses. Prior to serving at Capital Asset Strategies, Jason was the chief operating officer and general counsel at the American Investment Council for over 12 years. He also served in the United States Senate. So with that, I'm going to turn it over to Professor Sandeep Dahiya to take it away. Thank you.
Thank you very much, David. Once again, I would like to welcome our panelists, and I would like to start by making a brief statement about the topic that we are discussing today. These are the latest rulings on private advisors, the IA 6383, which was approved in a 3-2 vote in August 2023. The ruling focuses on how private funds are managed, and it focuses on improving transparency, disclosure, as well as compliance, or I should rephrase it as those are the stated goals of this ruling. Ruling is controversial. It has been challenged in the court. It's a huge document. It's over 600 pages, so we cannot go into nitty-gritty of everything, but to very briefly outline it, it requires the private advisors to a higher standard of disclosure. For example, they have to produce quarterly reports for all their investors, outlining performance as well as fee disclosures. It also requires much bigger burden of compliance. They have to keep books in a certain way, audits, as well as how some of the secondary transactions are done. And finally, it outright restricts certain things like allocating certain expenses or making preferential treatment that are hidden. They can make preferential treatments, but those need to be disclosed in far more detail. With that background, I am honored to have our esteemed panelists and guests at this event. What I would like to do is give each of my panelists an opportunity to give a short statement about what their view is about this regulation. So Tyler, we would start with you, followed by Jason, and then by Brendan. So if you could take a minute or so each and encapsulate what you think about these rulings.
Yeah, really quickly. So healthy markets, a number of our members are large asset owners. So you might think of state pension funds, as well as some smaller asset owners that are still in the private fund space. And if we go back in time to where does this rule come from, it's actually been over a decade in the making. So the SEC over a decade ago began in exams, and they found actually over half of the private funds surveyed had been misallocating fees and expenses. And they released a risk alert, and they released a report basically saying that. The examination staff, in fact, just days before proposing this rule, released another risk alert identifying concerns with how some of the private funds space is operating, particularly with respect to fees and expenses, but just knowledge about what's going on. And so the proposal was intended to do, as you alluded to, quarterly statements, make sure everybody has them. That shouldn't be controversial. Make sure you know what your own, what the valuations and the methodologies are. The audits are intended to do the same thing. An annual audit should be basic, relatively easy to do. Again, should be something that's standard practice and hygiene for most fund advisors. And then it gets into some more controversial things. So like secondaries, making sure there are third-party fairness opinions. And then even slightly more controversial things. Some of our members, in fact, most private fund advisors, have side letters where they get maybe a little more information or a little better rights or a little better fees or those types of structures that they have to negotiate. A lot of them fall into a bucket where kind of everybody asks, but everybody spends a lot of time and energy wasted on trying to negotiate things that every investor, every LP gets. But a lot of them fall into very special terms. And we might think of like the California Board of Regents just got with Blackstone regarding the BREIT as a way to sort of preferential treatment that's sort of unique to them. So some of those letters may put the investor in a much better position. Maybe maybe one of our members, maybe not. They might get preferential redemption rights or preferential information about the fund. That might benefit them, but it might hurt the other fund investors. And so if that's the case, the SEC straight prohibited it. So generally speaking, you can have these side arrangements. They just have to be disclosed so that other people might be able to negotiate them too. But if they go to the point where they might threaten the other investors, they're flat prohibited. And then there's other things like fees and expenses related to like underperformed services or waivers of liability for violations of fiduciary duty. They go to that too. All of those are issues. Every one of them has been one that's been talked about and asked for by limited partners for well over a decade. And so this isn't something new. What's new is we have a commission that was actually willing to do it and finally go into this space. With that, I'll sort of pause and let other folks jump in so we can get into the dialogue.
Thank you, Tyler. Jason?
Thank you very much. I mean, in my view, this overall rule is a solution in search of a real problem. A number of the issues that Tyler mentioned, are already common practice in private funds world. Now, they may not be common practice under the way the SEC has proposed it, but LPs and GPs in the private funds world have for generations had good productive relationships where they work together closely, they disclose the information that's requested of them. And if a limited partner doesn't like the particular deal or terms that they get from fund X or fund Y, they are more than free to go to any of the other thousands of funds that are out in the market looking to raise money. So it's a competitive market. It's a market that benefits limited partners. Don't ask me, ask the limited partners. From 2001, where limited partners on average invested about 1% of their capital in private funds. By 2020, that number was up to around 9%, and it's probably even larger now. And the reason for that is they like the returns, they like the investments, they like the strategy, and they feel that they do have a productive exchange with their GPs. So from my perspective, I think, a lot of the things that are in here is really an effort to push the whole private funds universe into being more like the public markets universe. Now, some might say, well, that's a good idea or a bad idea. But the reality of it is Congress has spoken, and Congress in law has said, look, there's treatment that you get when you're in the public markets. There's greater disclosure in some instances. There's different disclosure in others. If you're in the private sector, you are also subject to a stringent set of rules. It's different, but it doesn't mean that you're not subject to those. And so I think someone had mentioned litigation earlier on. There's a pending litigation that's on now that really challenges whether the SEC has the authority, the legislative authority to do this. And if it does, whether it did so in a way that's consistent with the Administrative Procedure Act. I respectfully believe that they've satisfied neither of those burdens. And people sort of just shouting Advisors Act, Advisors Act, Advisors Act doesn't mean that they have authority to do it. The SEC has relied upon general anti-fraud authority that it has to enact changes here that have nothing to do with fraudulent activity. They also have said that an unused part of Dodd-Frank that was tucked away in sort of an other section justifies all of the activity as well. And I just respectfully would say, Congress doesn't hide elephants in mouse holes. And I think it'll be very, very interesting to see how courts take a look at this issue, in particular, given a recent trend by courts from the Supreme Court on down to restrict regulatory caprice. There was a case a couple of years ago that the Supreme Court had where if you're trying to decide a major question and you're turning to old law to decide that major question, you have to get express authority from Congress to be able to make the major changes that you're making. And here, I think this rule tries to sort of turn the world on its head. And I think it does so in a way, ultimately, that's not favorable to private equity, private credit, venture capital, limited partner investors, or general partners. So I think it leaves an awful lot to be desired, and frankly, shouldn't have come out to begin with.
Our LPs are happy
for
the record.
So we'll definitely let the courts decide as how it progresses. But thank you for sharing your thoughts on that. And Brendan is actually one of the consumers of this product, the private equity. So Brendan, would love to hear your thoughts on this new ruling.
Great, thank you, Sandeep, and thank you for inviting me to participate in today's panel. So I am a trustee of our pension plan that is a limited partner, and I can tell you empathetically that we strongly supported the SEC's rule to provide this disclosure ourselves and many other limited partners that are pension plans. And the reason why this rule is so important is that private equity is a significant portion of most pension plans in the United States. And we're talking about trillions of dollars in assets under management. There's $9 trillion in public employee pension plan money. Union members through Taft-Hartley multi-employer plans have about another $1 trillion. On average, these plans will have about a 10% allocation to private equity. And it's not necessarily for the promised returns, but it's for the diversification of risk, particularly from volatility, and that pension plans need equity returns to pay promised benefits, and private equity, the fact that the investment returns are smooth and not mark to market is a feature, not a bug, that is attractive to pension plans. But we shouldn't have to overpay for that option to invest in private funds. Tyler referred to concerns going back over a decade that private equity general partners are overcharging and misallocating fees to limited partners. We have a market failure in private equity asset management, and that there's a lack of competition that is being driven by obscured fee structures that the investors, the purportedly sophisticated investors, even institutional investors as large as CalPERS, are unable to determine exactly how much they're paying in fees and expenses. That's an outrage that every working American should have, that there's an industry essentially acting, in seeking economic rent-seeking behavior, and it's being defended through obscuring fees, and it shouldn't be up to the consumer to have to negotiate with each general partner just for simple information on fees and performance. That is the role of the SEC to set the rules of the game. That's the role the SEC has long had under the Investment Advisors Act, dating back to 1940s. It's a simple matter of investor protection. And for these reasons, we strongly supported the rule. We believe that it was going to help reduce expenses for pension plans to help secure the retirement security of working people in this country. And so for those reasons, we strongly supported the SEC's proposal and its final rule and look forward to its implementation.
So if I can sum up from the hearing from our panelists is that on one hand, if I go with Jason's pushback on this thing is that, you know, it's a free market, you let the market decide, no one is holding anyone to this asset category. And on the other hand, Brandon, you very interestingly, you mentioned the issue of market failure. In other words, the markets aren't competitive enough to force people to disclose these arrangements. And I'm going to let that, you know, we cannot settle that debate. I mean, but I see what the arguments are. What I would like to do is like go back to some of this comment period that happened. And Tyler, just turning to you had mentioned FTX being a very interesting case in terms of could you discuss a little bit like why is FTX a relevant case like for this disclosure?
I think there are a couple of different recent relevant cases, and I don't know how many FTX specials of millennial founders misbehaving over the years we're going to get, be it WeWork or FTX or Theranos or however many of those we're going to get. But these are market failures based on the investment. But let's take a look at what the fund is doing. So we have the fund, and by the way, I want to bring up something that just was released yesterday by the SEC, which is examination priorities for 2024, which is going to be very relevant to this rule. So I'll footnote that for a moment. So the rule came out obviously well before FTX collapsed, right? And it was, again, as I said before, a decade in the making. But one of the things we have to think about is, let's think about how private equity funds or venture capital funds are doing their valuations, right? And as Brendan alluded to, also how we look at, or how a chief investment officer might look at those allocations and might look at the valuations based on them. So if we say, hey, this investment, this venture investment like FTX has gone from 0 to 8 to 24 to $32 billion over roughly 2 years based on a funding round, right? That someone says, and they've put, let's just say, a couple of $1 billion into it based on those valuations and funding rounds, including $95 million from Ontario Teachers Public Pension, right? And the fund advisor obviously didn't do enough due diligence, but let's also note they didn't note the CFO. But what's that valuation based on, right? What is the ultimate fees that might be allocated out to that? What are they paying for, in this case, a particular private fund advisor for? So the SEC is trying to say, look, we want it so that every investor kind of knows what they're owning. They know what the fee structure of what they own is. And then they have enough information to make an informed decision. But until you have that, we're at a place where the market is prone to these types of failures. And we've seen that. So FTX is one of them. Theranos is one of them. We can see until you have the transparency. And I want to use one more example. It's a fund holding. So a very large Northeastern endowment head said, hey, I avoided a significant loss. We outperformed our peer endowments because we had the transparency into the holdings of a particular fund. We believed that those holdings had valuations that were significantly lower based on our transparency into that fund. And so we sold that fund to another institutional investor. Turns out it's a public pension. So an endowment sells their fund holding because they knew of the underlying holdings. They believed those to be overvalued. What happens? The public pension had to take an immediate significant loss, right? So that's a transparency that was provided to one investor, not to a subsequent investor. And the subsequent investor suffered a significant loss based on knowledge. And that's the reason why we start to see the transparency being the hook that the SEC is looking for here.
So I would I would not go into very, very specific details. I have a very simple question for Brandon. Brandon, as an investor and LP, currently, do you get any information on what the holdings are and what the value of those holdings are? Because my understanding was that this is shared with LPs every quarter.
So the problem is that it is opaque and it varies by fund and LP and what they've been able to negotiate. And so it's very costly for LPs to first to negotiate access to that information and then to receive it. You have to do that on a fund by fund, investment by investment basis. So it's very different than investing in, say, a mutual fund for a retail investor where you have transparent disclosure of fees, expenses, and the portfolio holdings. And so, and remember that the option to invest in these funds, right, is during the fundraising window. So you don't know what you're going to be getting when you commit your assets, and you're locked in over the life cycle of that fund. So no, there is significant opaqueness, both for limited partner investors in the underlying portfolio companies that they're holding, as well as the fees that the general partner may be charging those portfolio companies, in addition to the fees that we're already paying as limited partners, known as portfolio monitoring fees that are being charged to portfolio companies. And some of the most egregious examples are where the general partners will accelerate those fees for work that hasn't been performed and may never be performed if the asset is sold or liquidated. And that's the kind of thing that this SEC rule is attempting to crack down on, to prohibit those type of abusive fee arrangements that are really double dipping, charging both the asset for the management as well as charging the limited partner that owns the asset for the management. It's a two-way street, but both ways of the road are filling the pockets of the general partners at the expense of the limited partners, and ultimately the retirement savings of working people.
Let me
I can jump in
Jason
here because
for-
there's just a lot of sort of, kind of phrases getting tossed around here. Let's go back to FTX for just a second, and then I'm happy to talk portfolio company management fees and everything else. But FTX was fraud, right? It's something that's already illegal under longstanding financial services regulatory rules. The same is true with Theranos, right? It's not that, if we had only had the private fund advisor rule, we would have been able to have stopped the fraud that Sam Bankman-Fried, when he was running around Washington sprinkling money in politicians' pockets, was also doing, right? So it's not the case that the real problem to FTX has anything really to do with private funds in general, or a failure of this rule to be passed. Second, to the point of, I often laugh because you're dealing with investors in private funds are some of the most sophisticated investors in the world. They are represented by sophisticated counsel. They do, as well they should, negotiate for the best possible deal that they should. And if they don't like the deal they get, then they don't have to invest. Nothing compels them to do so. But the reality of it is you've seen over time, the deals that have been beneficial for limited partners, they were great to begin with, they've gotten even better. Someone who mentioned portfolio company fees, which, by the way, were transparent and disclosed. Now, some firms don't use them, and the firms that do use them often share them and give them to their limited partners to reduce their limited partners' cost of investing in the funds. So, again, all of that happened through negotiation between sophisticated parties, consistent with the law. I think that's what you want in the private fund space. It is admittedly a different space than the retail market. You are dealing with sophisticated investors who are represented by sophisticated people. These are, they know what they're doing. And I think on the positive side, the reason why so many sophisticated limited partner investors, pension plans, university endowments, charitable foundations continue to invest more and more in the private fund space is because their net of fees, net of carry return exceeds what they get from almost every other asset class on a year-over-year basis. So I think it's a positive thing. It's a positive thing to allow investors to negotiate and get a deal that they are comfortable with and move forward. Or if they don't get a deal they don't like, they're under no obligation to work with a firm. And of course, they should know consistent with their own fiduciary duties, what they're investing in and why they're investing in it. And that's really on the limited partner investor to make sure that they do, and they do their due diligence. But, you know, the reality of it is these limited partners have been investing in this space for 40 plus years. This is not as if they, you know, they're like children in the woods and they don't understand what's going on from the magical private funds tree. It just doesn't work that way.
So let me jump in for a minute, and I want to transition this because it's very helpful to have views on both sides. And clearly on what, you know, one argument is that the limited partners universe is not of the same, like not everybody is exactly the same. You know, they have different resources, different skills, different ability to negotiate. To build on from Jason's point of view is, well, maybe a whole bunch of them should not be in this space. My own research shows that private equity as a class is not particularly rewarding in the last 10, 15 years. So this is something that there's always going to be tension, is that, you know, do you make it more transparent, that draws more investors, which might actually be good for private equity as a class. At the same time, you know, the whole raison d'etre to speak of private markets is that, you know, they are different from public markets. But it's very interesting to hear your thoughts. What I would like to do is, you know, we have probably about 10 more minutes or so, get into some of the nitty-gritty of this ruling. For example, like I was quite surprised by the fairness opinion on secondaries. And I would love to get everybody's thoughts on that. I thought secondaries were so small. Who buys secondaries? Who sells secondaries? I thought these were things that came up when things were you know, when funds had their back to the wall and, you know, like things were really bad. So I'm willing to be educated, and so I'm sure would be the audience. So why don't we this time, let me start with Brandon and, you know, go in the reverse order, Brandon, Jason, and then Tyler. Like, you know, would you like to share some views on the secondaries? If you have had any experience, like, did you ever have to sell your interest in a fund or buy somebody's interest in fund, Brandon?
Yeah, so I mean, our own fund, or my own pension plan that I'm a trustee of, we are opportunistic in terms of acquiring private equity positions from sellers. But you're raising a more important point, which is regarding private equity firms, you know, selling assets between themselves, right? Private equity markets are so large today. You know, there's upwards of 20 trillion, 27 trillion, depending on different assets and private funds. You know, that's rivaling the public equity markets. You know, for comparison, the total market cap of the U.S. stock market's about $46 trillion. So there's just these transactions are of enormous consequence, both to the limited partners that are investors in them, but as well for the economy as a whole. And so you know, the SEC rule, requiring assurance when there's a related party transaction involving a private equity fund. It's just common sense, and frankly, it's shocking that such a rule is even necessary. One would think that that would just be done as a matter of course. And so, but the fact that a rule is needed and that limited partners, including pension funds, are asking for these rules is evidence that this market is broken. And to Jason's point, you know, pension plans, we need to invest in private equity for diversification and for investment returns. I would question the point as to whether they're superior to their public market alternatives. But that being said, you know, we shouldn't have to overpay. We shouldn't have to overpay to invest in this as an asset class. And, you know, there's an old saying in asset management that hedge funds are not an asset class, that they are a fee structure. And we're all familiar with the traditional 2 and 20, the 2% asset management fee plus the 20% carry once you reach a certain hurdle rate. But it's all the hidden fees that are being passed on to limited partners and ultimately coming at the cost of working people's pension paychecks and retirement. And so that's what this rule is seeking to solve, to restore competition, because you can't have competition if you don't have transparency about fees. and the fact that limited partners themselves are struggling. Even the most sophisticated, financially sophisticated pension plans, large public pension plans, have teams of staff who are poring over this issue just to figure out how much they're paying. It's too much to expect smaller pension plans to be able to do, who don't have those financial resources, and certainly for accredited retail investors that they're just they're at the mercy of the general partners, and that's what this SEC rule is seeking to fix.
Thank you, Brandon. Jason, your views on the secondaries sales and the fairness opinion?
I mean, look, fees are transparent and overall returns over time don't lie. So if you want to ask why people invest more in private equity and other private funds, it's because they have outperformed the market over long periods of time, notwithstanding a great run up in the public markets over the last decade. So I think that's why people invest. On the specific issue of the secondaries, it is true that in market practice already, many firms provide either fairness opinions or valuation opinions before they do a GP-led secondary. I do think that one of the most interesting parts of the rule, though, and potentially one of the most problematic down the line, is the fact that what they will require, in addition to a fairness opinion, is a 2-year scoping of who provides the fairness opinion to both the advisor who's asking for it and any of their affiliates. And the reason I think that could be potentially challenging and ultimately challenging for limited partner investors is, if you have, like we have in the audit space, you got 4 or 5 major audit firms. And all of a sudden, if you have a fund that owns, multiple businesses and multiple jurisdictions, you could end up in a scenario where even though you're going to someone to get a valuation opinion on company X and fund Y, by virtue of the fact that that same company may have taken one of your funds in Europe and provided a valuation opinion for an entirely unrelated business, that would mean they couldn't provide a valuation opinion that would be deemed to be reasonable in this case. So I think I'm less troubled by the notion of fairness opinions in general, if that's something that certain LPs want. Obviously, ILPA had said themselves that they didn't think that a fairness opinion was necessary in all times. That is the Institutional Limited Partners Association. So, if some LPs are saying that, I think there should be some flexibility given there. But I think as a practical hurdle or a practical challenge, one of the most biggest difficulties here is it's going to be awfully hard to find firms that can provide these valuation opinions without always getting knocked out because of other valuation opinions that they're providing to the same firms. And I don't think firms or investors should be punished by that. But I think in general, if an LP wants a fairness opinion and there's a way to do it, that's probably less of a big deal. And it's something that happens in the market already.
Tyler, your views on the secondaries?
Yeah, so Sandeep, I think you raised an interesting question, which is why are we doing this anyways? And unfortunately, an awful lot of the time, it's part of a delay and pray, right? The secondary ends up being well, we're still not there yet, guys. And so you start to wonder, when you get a fairness opinion, one of the challenges are maybe you want it, maybe you don't. And that tries to explain Jason's point of sometimes an LP may want it, other times they may particularly not want it. Going back to the point of the asset class, or one of the features of the asset class, as Brendan alluded to, may be that the valuations aren't fluctuating. And it may be a little bit, I don't want to say counter-cyclical, but sort of acyclical, or at least a delayed cycle from the public markets. So you might be on, the valuations may change 6 months or a year later. They may go in the same direction, but they may be a lot slower to change in the valuations. When we start to think about, you're going towards the end of a life, you do have to worry about the self-dealing that may come along with an advisor-led secondary. You do have to worry about preferencing one set of customers or investors over another. And if I'm going to come back, and by the way, they're wonderful examples that I think Gretchen Morgensen has put into her book with Josh Rosner on this point, where you see, fund 7 goes to fund 8. And oh, by the way, the only thing that's changed is a realization of fees for the advisor. And in fact, the ultimate investors stay the same now with a reset valuation. And so those types of challenges are persistent. You may have fiduciaries from an asset owner who may feel the need to stay with it, to ride it out, who may not be in the position to negotiate an alternative, and they'll end up essentially being somewhat compelled to end up in that secondary. And so I think we have to recognize that that has happened a lot in recent years and is going to continue to happen in our current interest rate environment. So we're going to see this more, not less.
Oh, well, thank you. We are at about 36, 37-minute mark, and I would like to start wrapping up our discussion. And what I would like to do is the way I characterize this from the discussion is the ruling, if I read it right, is aimed at increasing investor protection and getting more disclosure for the investors. The flip side of that, as I see it, is like, these are sophisticated investors. How much protection do they want? And would it like curb the private equity market as a whole? Clearly, like the private equity market feels that way. Otherwise, they wouldn't be challenging it in the court. They wouldn't be pushing back against it. So what I would like to do is give all of you an opportunity again, and this time, I'll start with Jason, then Tyler, and then Brandon. Please take a few moments to collect your thoughts for this closing comment about this tension between better protection for the investors, more disclosure versus maybe this might stilt the asset class itself as a thing. So go ahead, Jason, then Tyler and Brandon.
Sure, thank you. Well, look, I think obviously you want to have, in a perfect world, you want to have excellent transparency, and you want to have a market that's dynamic and able to meet the needs of the limited partner investors and the businesses who come in and and want financing and funding from the private market sector. So I think this rule, the notion that the private funds universe is not transparent is just a misnomer. And we've talked about it. It's sort of come out in the context of this conversation. There's already tremendous amount of disclosure, voluminous disclosure given to LPs by private fund advisors. And, if LPs at the end of the day don't like the particular terms or a particular investment that a fund's offering, they don't have to invest there. They have plenty of other choice. Competitive market, it's not a market failure. It's a market operating correctly. And I think it is true, though, to your point, that if you impose almost public market style regulation on private markets that are designed to be more flexible and able for sophisticated investors to invest in businesses outside of public markets, you could end up with a scenario where returns go down, fees go up. So from a limited partner perspective, if you like lower kind of lower returns and higher fees, then you'll love the private equity fund rule that the SEC's come out with. So I understand, obviously, and private funds are highly supportive of transparency. It's one of the hallmarks of the overall industry since it began 40 years ago. And I think if you've seen over the last 10 or 15 years, the amount of transparency has only increased tremendously. But I think you need to also make sure that those two concepts, transparency and performance, are not mutually exclusive. But you have to avoid, killing the goose that lays the golden egg. And we feel like that the rule in many ways sort of goes above and beyond, a mere disclosure rule, and gets the SEC away from its role as a disclosure-based advisor under the Advisors Act and puts it more into a, sort of a merit-based regulator, saying whether it likes this term or that term, and then forcing sophisticated LPs and general partners into that rubric. So I think you can have transparency, and you already do, and you can have a dynamic market that functions well for all participants without this rule. And I don't think this rule is really helping either of those scores in a way that's going to be meaningful over the long term.
Well, thank you, Jason. Tyler, your views on?
Yeah, I appreciate it. It's interesting because I'm sort of curious as to what LPs he talks to, because when we think about sophisticated investors, and we say sophisticated investors a lot, we've used the word sophisticated a lot, actually, other folks have on this call. We're talking about everyone ranging from dentists to CalPERS. So we're talking about someone who may have maybe $1 million, maybe, to $800 billion or more in assets. And there's a pretty big variability in expertise, lawyering capabilities, and there's also going to be a huge variability in what they get. The SEC is requiring quarterly statements. I call that not a merit-based, but a disclosure-based regime. They're requiring that those be audited so that they're reliable. Again, a disclosure-based regime. They're requiring disclosure of side letters. Again, a disclosure-based regime. They're requiring line items about those quarterly statements. So what your fees are, those types of things. You know, it's interesting because our members are some of the firms that I think qualify as the most sophisticated investors in the world. And they're the ones who are saying, we aren't getting what we need. If they were already getting all of what they would need, they wouldn't be the ones paying me to write letters to the SEC saying, please do this. I wouldn't have that job. And Brendan wouldn't have that with his institution as well. So it's interesting to me to hear that this is somehow not disclosure based when that's the requirement. And it's all interesting for me to hear that everybody gets what they want or what they're able to negotiate or they can walk away, when frankly, those are the folks who are writing my checks. That's the reason, one of the core reasons why we at Healthy Markets exist, is to identify those types of market failures. And we're trying to do that. So we're ultimately very pleased with the guts of the rule. And I think, by the way, Jason was correct. There are certain technical issues like who can offer a fairness opinion and how and when and under the circumstances that I do think have to be worked out. The SEC, there are parts of this rule that we think may have stretched a little bit. For example, not everyone knew that maybe having a disclosure about violations of your fiduciary duty would itself be a violation of your fiduciary duty, or waivers of liability would somehow violate fiduciary duties. Some of those things about this rule, I think, are going to be revisited. The good news is that'll happen over time. In the meantime, we're going to see everybody knows what they own, they know what they pay. That seems like a more efficient marketplace.
Thank you, Tyler. Brendan, closing thoughts before we wrap up the session for today?
Yeah, the private equity industry's lawsuit against this common sense regulation is pure and simple rent-seeking behavior. They're seeking to hide fees that limited partners, including pension plans, pay. And there's tremendous amounts of money at stake here. Last year, the highest paid CEO in the United States was Steven Schwartzman, the CEO of Blackstone. He received over $253 million in total compensation, more than 10 times the average S&P 500 company CEOs pay. There's a tremendous amount of money that's at stake. And the fact that the most sophisticated institutional investors are demanding this disclosure and demanding the SEC to set rules of the game shows just how broken the private equity fee structure is in terms of providing that needed transparency. The less sophisticated private equity limited partners, they don't even know what they're paying, and that's a real shame. And that is what the SEC is seeking to correct, to protect investors by providing a common denominator disclosure of fees and performance that will facilitate competition between general partners, ultimately lowering investment expenses. We've seen investment expenses decline tremendously over the past several decades in the public equity markets and the fixed income market, but not in private equity. Why is that? It's because there's been a market failure, and that's exactly what the SEC is seeking to correct.
Well, thank you for sharing your insights, and clearly it is and continues to be a controversial topic, and we really appreciate hearing from all different perspectives. I would like to individually thank my panelists for taking the time and sharing their thoughts as well as insights on this topic. I hope you will continue to stay engaged with the center. We are going to wrap up at this point, and I am going to close this meeting by simply ending the Zoom meeting. That's how we'll go out of the meeting. David, is there anything that I missed that needed to be touched, or would
No, I just also want to thank you for moderating this panel, Sandeep. And I also want to thank Tyler Gellasch of Healthy Markets, Brandon Rees of AFL-CIO, and Jason Mulvihill of Capital Asset Strategies. Please be sure to follow the Psaros Center on Financial Markets and Policy on LinkedIn and Twitter/X, as well as our YouTube channel. Thank you.
Thank you.